Good day. I am Banny, and my job is to provide you with daily business and financial news. Netflix announced the delay of its password-sharing crackdown and reported mixed financial results on Tuesday. The delay may cause a delay in expected membership growth and revenue benefit to Q3. The company said its subscriber growth was affected in international markets where the crackdown was already rolled out. Netflix reported earnings per share of $2.88 versus $2.86 expected, and revenue of $8.16 billion versus $8.18 billion expected. Netflix's earnings were $1.31 billion, or $2.88 a share, compared to $1.6 billion, or $3.53 a share, a year earlier. Netflix's shares initially fell more than 10%, but recovered to rise slightly in after-hours trading. Investors have been concerned about Netflix's efforts to address password sharing. Netflix announced in late 2020 that it would introduce measures to encourage people who use borrowed accounts to create their own. The company revealed that over 100 million households share accounts, which represents around 43% of its global user base. Netflix has indicated that this has impacted its ability to invest in new content. Both the ad-supported option and the crackdown on password sharing are aimed at boosting profits. In February, Netflix provided password-sharing guidelines in 4 countries: New Zealand, Canada, Portugal, and Spain. The guidelines asked users in those countries to designate a primary location for their accounts and permitted them to create up to 2 sub-accounts for users who don't live in their home base for a fee. Netflix has expressed satisfaction with its efforts to address password sharing. The company noted that its announcement regarding the crackdown led to cancellations in Latin America, which had a short-term impact on growth. However, many of the former password borrowers later activated their own accounts and added existing members as extra member accounts, resulting in increased revenue for the company. In Canada, the introduction of paid sharing has led to growth in the membership base and accelerated revenue growth. The company expects engagement to decrease slightly in the short term as it introduces its paid sharing initiatives, but it anticipates a rebound in engagement in the future, as seen in international regions. In other news, Netflix plans to spend around $17 billion on content in 2024. Although the competition for entertainment content is intense, Netflix is not pulling back. The company is phasing out its DVD mailing business, which was its initial business model. The CEO of Netflix, Ted Sarandos, said in a blog post that the DVD business continues to shrink, and so the company has decided to finally wind it down. Netflix also experienced its first subscriber loss in a decade, causing the company to focus on profits over subscriber numbers. To increase profits and subscribers, Netflix has turned its focus to an ad-supported plan and a password-sharing crackdown. The company unveiled its cheaper ad-supported tier last November, which costs $6.99 a month. This came after it lost subscribers due to increased competition in the streaming market. Recently, Sarandos revealed that the company may offer multiple ad-supported tiers in the future. Netflix's ad-supported plan has an average of 95% of the same content as its commercial-free plans, thanks to recent licensing deals. What do you think of Netflix earnings report, as well as the dismantling of their DVD business? Let me know in the comments below. I am curious to hear your thoughts on this topic. Also, if you want to stay updated on the latest business and financial news, hit that like, share, and subscribe button. Take care, and have a great rest of your day.